both, sit at the intersection of like major money flows, major investor sentiment. You're all over the world. And that's just for like a 30-second level set from both of you on like what you have made of the last, call it, 17 days, 18 days?
Wow, feels like longer than 17 days. We work with clients on a long-term basis, and we have in place plans that factor in periods of market volatility. So our clients, we spend a lot of time talking to them about stay steady, let's stick with the long-term plan. Are there pivots we want to make based upon opportunities that might arise in the market because of sell-offs or things like that? But our message is stay steady and stay calm. What they're looking for, which everybody's looking for, is some stability, some predictability, having all this settle in a little bit. But for us, in short periods like this, we're very focused on making sure the clients stick with the long-term plan and don't react to a market that literally can change by the day, which has happened in the last 17 days many times.
Jenny, is this a set it and forget it environment?
Absolutely. I mean, and what has probably surprised us a little bit, and Franklin Templeton is sold through firms like Rockefeller, so usually there's a financial advisor there. But a lot of times that channel will react to these kind of volatility, and and they'll panic when the markets drop. And we've actually seen them be pretty steady, and I think that's the good news. On the institutional side, you saw in certain places, I do think the Europeans have reduced a little bit of exposure to U.S. equities. We've seen that a little bit on the institutional side. I don't think that's a long-term sort of play.
Is that an emotional play, or is it their portfolios got a little out of whack?
Well, I think the European index has been the best performer of so far year to date. So it may have had something to do with that. But if you hadn't positioned your portfolio, there's no point in making the changes now, right? Because you really, if you're in cash, you're probably staying in cash for a while. If you're already in the market and you hadn't moved to more defensive sectors, there's no point in doing that now, because at some point you're going to see, look, the technological innovation that's happening is still very real, and those are going to come back.
Can I just make 2 points in terms of the long term versus the near term? One, retail investors in the U.S. have continued to buy on most of these dips. And the second thing is, in terms of like European investors, you had 70% of global market capitalization was U.S., I think at the end of 2024. There was going to be some adjustment to that, and there was going to be investment in places outside the U.S. before all of this. There was no question there had to be some balancing on that. So some of those institutional investors may have had that in place, as Jenny said, before this.
Are you surprised that it's Europe, though? I mean, the Gulf is interesting. Japan has a lot of tailwinds. Europe, it's had a tough couple of years. Does this have legs?
We'll see. I mean, it has had a tough couple of years, and but it is a 350 million person marketplace. It's a huge economy, and there are signs that it might be different this time in places like Germany. So we're going to find out.
Well, and I think on that, the joke was, is it MAGA or mega? Is it make Europe great again? It is a wake-up call for Europe a bit, right? The U.S. is saying we're not necessarily going to continue to cover you on defense. They've seen what's happened on on being so reliant on others for energy. And if you think about Europe, why haven't there been more tech unicorns there? There's obviously brilliant people, and a lot of that I think is the dynamics of the regulation and just kind of the environment. And so if this is a bit of a wake-up call where Europe says we can't rely on the U.S., so we've got to work together to figure out a better plan here so we can be a little bit more self-reliant, I actually think that's a really good thing.
Do you think it's the regulation, or is it the capital? And I ask because is there a moment now where Harvey was just on saying
it's a lot of things.
Is there going to be more pressure for German pension funds to buy German stocks, for Canadians to buy Canadians? Is there a way to get more of a domestic capital market going in Europe, just frankly out of spite?
Spite is a hard thing for investors to follow because investors are trying to make a return on the money. So, one of the things that I think is going to be clear as things settle here is that investing is going to remain global. I mean, Franklin's got a global footprint from an investment standpoint, and investors are going to follow wherever they think they can maximize yield. So you might be able to to try to create more of a dynamic financial market in some of these countries and maybe across the European Union, because that is one of, as Jenny said, this country's greatest strengths. The innovation process, the entrepreneurial process, the capital formation, the capital getting into the right companies' hands. Some of these, these huge companies that we spent so much time talking about, 15 or 20 years ago, these were startups. This country does that really well. Whether the Europeans, individual countries, or across the European Union, they can set in place events to make that happen. We're going to find that out.
You mentioned that retail has bought a lot of these dips. Is that a good thing? Like, we obviously want retail invested in the market, but what do the institutions know that individual investors don't, and are they just catching the knife at this point?
Well, I think one of the things the markets are telling us day after day is that nobody really knows. Where is it going to settle here?
Yeah.
There's obviously a lot going on the tariff front. So how much our institutional investors are privy to something that retail investors aren't. I think that retail investors have done so well investing in the dynamic American economy that it pulls them back in. And I remain upbeat, as I'm sure Jenny does, on where this country is going. Jenny was starting to go to technology and artificial intelligence and the impact of that on productivity here. So if we can get some settling and some steadying in the marketplace, I think those retail investors could still be rewarded.
Are you starting to see, the concern, I think, is that when things fall in the stock market, people feel poorer, and then it becomes a real economy problem. And I'm curious, you guys look at sort of your customer balances. Is the wealth effect, are we in the middle of that and we haven't quite felt it in the real economy?
So I'm going to answer the risk slightly differently, right? Not, and again, the economy and the market are two different things, right? They're tied, but they're two different things. And so, if you look at where we are today, you have to remember, so Trump has said, I care about tariffs, immigration, taxes, government efficiency, and deregulation, right? He's kind of laid those things out. And actually, he's been pretty dang deliberate since he's gone in. He's, trying to address them. And if you look at where he is on tariffs, let's face it, if you're going to negotiate, right? He's a deal guy. You're going to negotiate. You want to demonstrate that you're negotiating from a position of strength. So you do it, and I laugh because somebody told me to look at like Worldwide Poker and watch how some of these people do it, and they'll be like, oh, that's a boy bet, flipping the chips, right? It's a distraction. So there's an element of this that's part of his way of negotiating a deal. Now, he also, to get his tax, and we call it tax cuts, but the reality is there will be a massive tax increase in this country if the tax cuts are not extended. There'll be some additional tax cuts, but just think about if that isn't extended, how big of an issue that is from the economic standpoint. So to get those, he needs to be able to demonstrate that he has either generated revenue or cut expenses in the order of somewhere between $2 and $4+ trillion. So if you're actually thinking in terms of your broader framework, you have to think, okay, he says this is a $600 billion revenue benefit with these tariffs. You don't want to negotiate too many deals because when you have to get your tax cuts done, you need to be able to say it's $600 billion. Now, we'll see what the CBO says, but that's an important part of his story, right? But the risk, so that you're asking about the risk is you talk to CEOs. One is they can't provide guidance, or if they provide guidance, there's so many caveats to it that everybody realizes, all right, I don't know what that means. Number two, anytime there's uncertainty, you stop making capital expenditures. And so when businesses, start to hesitate on that because they need to be in a wait and see mode, that's going to become an issue for the economy. And then the final thing is the unintended consequences. The fact that, our customs system can't handle the tariffs actually being inputted. So there's a potential of packages being stuck at the ports and shelves being empty. That all becomes a self-fulfilling prophecy of risk. And so he's got a window where he is trying to balance kind of the trade agreements with ultimately, I think, the tax cuts. And it's threading a very fine needle.
Greg, were you heartened by, there's all this talk of, is there a Trump put, right? Is there a pain point at which he's going to back off? Ultimately, I think the strike price was perhaps a bit lower than people had thought. But are you heartened by the fact that there was a feedback loop, that actually the one thing that the president has been sort of unable to fully bully and knuckle over has been the market. Is that heartening to people? Do you get the sense someone's listening?
Well, that's one of the things I've been I've been saying a lot recently, which is the markets have been clear on an immediate basis as I've seen in my career, which is now 37 years. So the market messaging around different steps has been a break and clearly has had a real impact on some of the near-term decisions here. But one thing, Liz, I wanted to come back to that Jenny was talking about that's a really key piece of where we are going forward is this budget deficit. And when Scott Bessent was first confirmed as Treasury Secretary, he was talking about 3, 3, and 3. We would get to 3% inflation, which looks like it's not going to be a problem. The issue is keeping it there. 3% real growth, which would be wonderful to see. Technology and AI may have a part in that. But then a 3% budget deficit. Before all of what's happened with tariffs, the big issue for this country, and it was already impacting us in terms of things like dollar and treasury yields, is the fact that we were running a budget deficit of 6 to 7% in a positive economic time. Over the last 5 years, just one statistic and I'll stop. From 1945 until today, receipts as a percentage of GDP were about 17% a year, and spending was 19% a year. So there was a gap. We had, obviously, when Bill Clinton left office, to remind everybody, there was a budget surplus, but there's a 2% gap. In the 5 years, 2019 to 2024, receipts as a percentage of GDP were 17%, and spending was 27%. That was unsustainable coming into, we obviously have a new administration, but whoever took office last November had to and still has to deal with that. So that's in front of us here.
And the backdrop of that, what's allowed us to do that is people have been willing to buy our debt for a really long time. Mm-hmm. And we've seen some, I'm curious whether you think this was just a little bit of a temper tantrum or whether there has been sort of a reset in how creditworthy people think the United States government is. Jenny, what do you think?
Look, I think, you have people speculating like, will the U.S. be the reserve currency? Is that at risk? No, it's not at risk because there's nowhere else to go, right? I think the question, and as Greg pointed out in the debt, so we went from 2007, 9 trillion to now like 33 trillion, right? Guess what? We got to fund it, and something like 70% of it turns over in 5 years, and so you have to attract. It's still risk-free. I don't think people are thinking there's a better option. But at what price will you choose to buy treasuries versus something else? And as you have grown the deficit, you just need more buyers to be able to do that, and that crowds out other investment.
One of the things I'll say here is that people's willingness to buy treasuries in very difficult times throughout history, very difficult times around the world, people buying treasuries throughout the world, is tied to the stability, the predictability, the reliability of the United States. And that's one of the things we have to keep in mind as we're going through these times where there's a lot of policy change. We want the rest of the world to still look at us as the economic superpower, and they can rely on us doing things going forward the way that we have for so many years historically, including rule of law, the way the financial markets work, and we need to be careful with anything that provides a real taint on that.
But the safe haven asset over the last 2 weeks has been gold.
Yeah.
Like that doesn't seem like a good sign of anything, no? I mean,
Well,
what do you think of that?
First of all, I say it's 2 weeks. Because I'm with Jenny, I get this question on reserve currency, and I say, okay, so what are the options? And that was true again. There's been discussion about reserve currency status back to Russia when they went into Ukraine, and so many of their assets were frozen around the world. People say, well, wait a minute, America's overreached, and
the concern is that if you weaponize the dollar.
Exactly.
Right,
so that's now been around for a number of years. This is still by far the biggest and strongest and most dynamic economy in the world. So I don't see the dollar at risk as the reserve currency. But I do make the point around the perception of us as reliable, steady. They do things a certain way. You can count on them to do it that way in 10, in 20, and 30 years. And we need to be careful with that.
Let's spend the remaining time we have left talking about private markets a little bit. Which is, this is the first crisis where you've had a real alternative to public markets, a lot of money there. I'm curious, we haven't quite seen the earnings come out yet, but you look at some of these and firms that invest in both sides, they're public portfolios are down 10 or 15%. But lo and behold, the private markets are exactly where we left them in December. And Jenny, Franklin Templeton has leaned into this business. Is this exactly a proof of concept? The private markets are supposed to be a little insulated from the gyrations of the public market, or is this just head in the sand stuff?
No, I mean, I have this debate internally too. The reality is, it is permanent capital that backs those, right? So the good news is, I mean, if you think about a pension fund let's just take 2022 when fixed income and equities both dropped, their assets in the private markets actually had a premium because your ATM to pay your pensioners had to come from all your liquid. So actually in times of stress, there is actually a premium value to the fact that it's permanent capital. Now, I always say, well, so what is the mark to market? Well, they don't mark to market in the same way. I think they say that private equity, it takes about 6 months for it to mark, and it marks about half of what the equity markets are down. But there is the reality of what happens in overselling because something is liquid in times of stress.
You still see a lot of appetite among your clients?
Tremendous appetite. Our client base is high net worth and ultra high net worth, primarily American families. And if you have the wealth to be able to invest in privates and deal with the illiquidity, the fact that it's a longer term investment, you should have a significant percentage of your wealth diversified across a range of different privates.
Okay. We'll check back in 6 months for those marks. I'm very curious. Thank you both so much.
You're welcome, Liz.
Thank you.
Good to see you.